I'll be the first to confess it and the first to tell you that there is a gap between the stock market and the current economy. However, it will be a headwind if the environment as a whole is underperforming. It will be a difficult fight. We will now go further into the three reasons why our stocks falling. The stock market is crashing for three reasons. First, according to the Federal Reserve, rising interest rates and high inflation will have a detrimental effect on stock markets. The P/E ratio needs to decrease. Second, we are now seeing mean reversion, which is the ultimate return of asset values to their long-term norms. It will be the P/E ratio in this instance. The third factor is the macro environment. Hello everyone! Welcome to Finance Wisdom. In this video, we're going to talk about why are stocks falling. Stock market crash explained. If you are new to this channel, do like and subscribe to the channel. Again, I'm going to be explaining everything to you as if your level of stock market knowledge is somewhere between ignorant and beginner. And you know there's nothing wrong with a beginner, and this is a terrific place to learn. We're going to start with inflation and interest rates. If you're an investor at the intermediate level, I'll probably fill in some of the blanks. If you're an experienced investor, you won't learn anything from this video. We'll begin by discussing interest rates and inflation, okay? We are all aware of how high the inflation rate is. It's nothing to be proud of, especially when it has escalated to its greatest level in 41 years. The Federal Reserve is raising interest rates to combat this. Therefore, increasing interest rates will cause the economy and demand to slow down, which will stop price inflation. Future profits will be worthless as interest rates rise. This is the reason why unprofitable IT businesses and growth stocks are being decimated in the stock market. I'll make things extremely clearly for you to understand. I think that the best way to show you this is by giving you an example. Let's imagine that you were offered the chance to invest $2 million in a firm and that you knew that if you did, you would earn a profit of $200,000 over the next 10 years. Please tell me the interest rate that you majority of individuals get on their savings accounts. Consequently, you deposit $1 million in the bank. Most people's interest rates are below 1%, making them essentially nil. Interest income is non-existent for you. Consequently, you deposit $1 million in the bank. How much money will you receive? How much interest income can you expect to receive over the course of 10 years? It will thus be close to zero in this scenario. As a result, in our hypothetical scenario, purchasing this business for $2 million and expecting to earn $200,000 over the next 10 years seems preferable to putting your money in the bank and earning nothing. The company's projected profit seems rather attractive. But if interest rates change, for example, if the interest rate on your savings account rises to 5%, that would radically alter the narrative. In that instance, you may now deposit your $2 million in the bank and start earning $100,000 a year in interest income, which will amount to $1 million after 10 years. That would be ignoring compounding. Therefore, in this example, future profits of this corporation seem to be a horrible investment in an environment with increased interest rates. If interest rates increase to 5%, I would only be ready to pay $400,000 for the firm, not $200,000, as originally planned. This is due to the fact that if I paid $400,000 for that firm, it would generate $200,000 in revenue for me, representing a 50% increase. So if I were to invest $300,000, I would earn $150,000. What, after all, is the alternative? I could simply take $2 million and deposit it in my savings account, which now earns 5%, and earn $1 million, netting me a 50% return. Naturally, it is oversimplified, but that is the general idea. What will happen to the value of future profits in an environment with increased interest rates, and why are growth stocks unprofitable? They are unprofitable growth stocks and tech companies since they are now losing money while claiming that they will be profitable in the future. They are taking more damage than others are, and are losing everything. I want to make clear that certain companies like financials will profit from an environment of increasing interest rates. But you shouldn't rush out and purchase financial stocks after seeing this video since the market is forward-looking and people have already considered this. That is in the future though. For beginners, Examples of present value, time value of money, discounted cash flows, and opportunity costs are provided. If you like this video, don't forget to like and subscribe to the channel. Factor number 2 on why are stocks falling. The PRE ratio must come down to its mean reversion. I'll simplify and neatly break things down for you. The stock price divided by the earnings per share is used to calculate the PRE ratio. In this case, the PRE ratio would be 10 if you were to accept an offer to acquire a company for $100 and it generated $10 in profit annually. The price is equal to $100 divided by $10,000 in annual profits, giving it a PRE ratio of 10. A high PRE ratio is often seen as an indicator of overvaluation. The price is equal to $100 divided by $10,000 in annual profits, giving it a PRE ratio of 10. A high PRE ratio is often seen as an indicator of overvaluation. Therefore, if you get an offer to purchase a stock of $100 and it earns a $1 profit per year, the PRE ratio will be $100. If the PRE ratio was low, you would have to work for 100 years to get back your $100 because it is often undervalued. If you get an offer to purchase a company for $100 and they generate a $50 profit annually, according to the PRE ratio, it would take you 2 years to return your $100 investment. Now that we've established that, allow me to share some statistics with you. The S&P 500's historical PRE ratio ranges from 13 to 15, depending on the year or time period you're considering. The S&P 500's PRE ratio in the contemporary period is 19. In the second quarter of 2022, the S&P ratio will be close to 20. We're simply reverting to the average since the PRE ratio has been declining over the past 2 years from above 30. But before you assume that the crash is over because we're approaching the average of 19 PRE ratio, consider this. If companies are earning less money, their earnings will be denominator and the PRE ratio will go down, which means that the PRE ratio will group and there could be more downside risk. In the end, the PRE ratio was just too high, and since stock prices are declining, the PRE ratio is returning to historical norms. Factor number 3 on why are stocks falling, you must be mindful of your microenvironment. What does it mean when the tide is rising and all boats are lifted? I mean, all of you cryptocurrency speculators know this and have first-hand knowledge of it. If the value of Bitcoin rises, the value of 99% of alternative currencies will rise as well. Cryptocurrencies will prosper if Bitcoin is doing well or poorly, respectively. Similarly, even if you aren't investing in Bitcoin, you still need to be aware of Bitcoin's performance when purchasing or selling cryptocurrencies, since it will have an impact on your altcoins even if it doesn't touch 90 or whatever percent of altcoins. The stock market will experience the same thing, and I'll repeat that I realize that the two are unrelatable. Nonetheless, if the current economy is struggling, the stock market will face difficult conditions if the Federal Reserve don't step in and start printing more money. Don't fight the FED was a proverb that was popular throughout the previous 10 years. The majority of people are aware that the Federal Reserve has been printing copious amounts of money, flooding the market with so much cash that all financial assets, including stocks and bonds, have seen increases in value. When there is so much money in the economy, you have to put your money to work somewhere. But currently the situation is the reverse since the Federal Reserve ceased producing money 2 months ago. The celebration is over, yet there's still more. It will only get worse because the Federal Reserve created so much money. Things are only going to get worse. Within the next 3 months, they'll begin removing that money from the system. Don't resist the FED because they're going to be taking back $47.5 billion a month at first and then $95 billion after that. I do want to make something clear. However, in our monetary system, the Federal Reserve doesn't particularly like physically printing money. The US government produces money by engaging in deficit spending, and banks then lend that money into existence. However, the Federal Reserve is essentially complicit in this plan. To summarize, they are printing money. Interest rates are rising as a result of quantitative tightening by the Federal Reserve. This will increase the pressure on equities, bonds, and cryptocurrencies. I hope this clarifies the situation for you. We've reached the end of another video and thank you for watching. I hope you have learned why are stocks falling. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.